Hi everyone. I'm very excited to be here to discuss about global funding gaps. But before we start, you will see on the screen a little QR code. Please scan, and you will be able to ask questions that I will receive here and that we can address at the end of the session. As I was saying, I'm very happy to be here and to moderate this panel with three amazing speakers. They are all investing in very different regions. But before we deep dive in the topic, I would like them to introduce themselves very quickly. Maybe we can start with Scott. Very quickly, can you tell us who you are, what you're doing at ACME, and where you're investing in?
Sure. Hi, my name's Scott Stanford. I live in Los Angeles, ACME Capital. We were Sherpa Capital initially. We changed to ACME. We're about $1.2 billion under management. We focus on what we call traction bets because these letters make no sense anymore in terms of round sizes. We're about a $300 million fund. Also started an advisory business that works with large corporates to help them with innovation. Prior to that, I ran Goldman's internet investment banking business for a decade and had a fund when I was at Goldman. And prior to that, I helped build an internet company back in the bubble that Goldman took public.
James, do you want to follow up?
Yeah, thank you. Great to be here, everyone. So my name's James. I'm here from Dara 5. I'm the investment principal there. We invest in both funds and companies. So we invest in pre-seed to Series A funds as an LP, and then back their best performing companies that come out of them at a Series B stage and beyond. We invest across the US and Europe, and happy to give the LP/family office perspective today.
Thank you. And last and not least, Nicolas.
Thank you. Nicolas Sauvage from TDK Ventures. Let me ask asking a question. Who knows TDK? Raise your hand. So a lot of young people. So for the younger who didn't raise your hand, that was a cassette that your parents used to listen to music. Now they moved on, and TDK is now really a global tech company, developing the latest sensors in your mobiles and your cars and everything. I started the corporate VC in 2019 for TDK, so TDK Ventures. We are global. We have a team of 35 people. We have invested in 44 different deep tech companies across 3 different funds. And we like to invest very early stage. So inception is nice, but it could be seed, Series A, sometimes Series B.
Thank you. So as I was saying, our topic is global funding gaps and mapping high potential regions. But before, we would like to give you a bit of an overview of what is happening in the funding landscape right now. And Nicolas, I know that you have a very particular catchphrase, I would say, which is VC dying? Could you give us your perspective on that? Okay,
we start with spicy question. So it's more a question than an opinion, but I think venture capital today is based on funds which last for 10 years, can be extended by 2 years. So it's called 10 plus 1. And today, successful companies that VC have invested in may stay private for much longer than the fund life. And what that means is it's very difficult for VCs to get that success out back to their LPs, which means the money is very difficult to recycle back to VCs, back to entrepreneurs. And part of it, I think, is also because entrepreneurs don't feel the need to go IPO, and if they're successful, they may not want to consider an M&A. But they have now liquidity access, which allows for their teams to get some of the success during the journey. And so the question is, do we need to redefine venture capital as it has been done so far?
Very interesting. I know that, Scott, you share kind of the same opinion. Could you give us your perspective, and based on your experience, why do you consider that VC is broken?
So it's evolving. I wouldn't say it's necessarily broken, but things are going to break, that's for sure. They already are. I wrote a letter a little over a year ago to our LPs saying we're entering a 4th phase of venture capital. There's been 3 distinct phases prior to here. You had the proto-tech era of 1940s to 90s. That was like the real deal, craftsmen making semiconductors. Then you go into the dot-com era, and then you hit the appification, the mobile era. And now we're entering this fourth phase, and it's really, really, really different. We love metrics, we love numbers. Let's look at those three phases. In phase one, there were 300 venture capital firms. In phase two, there were 700 venture capital firms. In phase three, there are 3,000 venture capital firms. Are you kidding me? Like, it makes no sense. So I guarantee you there's not going to be 3,000 venture capital firms in phase four. There's probably going to be 1,000, maybe 1,500. I think half of them are going to go away. And so what we and others are doing is looking ourselves in the mirrors as venture capitalists and saying, what's our right to exist? It used to be a PowerPoint presentation, some nifty slides about trends and themes, and, oh, look at my LinkedIn profile and my network. Yeah, you and 2,999 others. So what is your right to exist as a venture capitalist is a question that you have to ask yourself if you're a VC. And if you're an LP, you have to say, what's your right to exist to that GP? And when you ask that hard question, you find there aren't a lot of great answers. Because innovation it's not elastic to capital. You can't pour more money on innovation. You're going to get more outcomes. And by the way, to your point, the backlog of outcomes is a disaster. The unicorpses, there's trillions of dollars of unicorn value sitting there. If you took the backlog of $500+ million companies and said, okay, let's flush them based on M&A and IPO volume, it would take somewhere between 25 and 30 years, using the average last 3 years of IPO and M&A exits. It's broken. It doesn't work. And corporates, are the corporates going to show up and buy these? No. The corporates are tech companies now. 9 out of the top 10 public companies are tech companies. That used to be 2 several decades ago. So the incumbents are tech companies. They're not the Time Warners buying AOLs. It's not irrational euphoria around tech. And lastly, AI. This is very different than anything we've ever seen. We talk about platform shifts all the time. This is a paradigm shift. AI is accessible to everyone from day one. Google did not offer an API when they launched. Facebook did not offer an API when they launched. LinkedIn has a really shitty API. Like, you've never had this access to something this powerful from day one. So unless the incumbents are brain dead, they are going to integrate AI fast because they can. And AI will code itself. Like, it sounds cliche, but like, we're underestimating the power of AI. And so from a venture perspective, you can't have this, I'm just going to fund it and someone's going to buy it mentality. You have to manufacture your exits. You have to be really smart when you invest in that Series A or Series B. Who the hell is going to buy this thing? Because the public markets have been burned. They got burned with the SPACs. SPACs weren't a problem. It's the fact that we put companies out there that were too early for the public market's appetite. And they don't want that risk. They want 6, 7 trailing quarters of EBITDA. You know how many of those unicorns have 7 quarters of trailing EBITDA? Count them on a couple of hands. So there's a problem here. So yes, it's an evolution, but I'm optimistic. I think it'll be a good thing for the industry. It'll be a good thing for prices. When you look at the prices of Series A, if you don't move quantity and you just move demand, prices go through the roof. And guess what? Prices have gone through the roof, and it's destroyed ROIs. So phase 4 of venture capital is coming.
Yeah. James, do you want to share?
I was going to say one thing to pick up on there. So I definitely agree with the number of funds and that kind of needing to be reduced. But I think what we've got to be very careful about is the concentration risk that venture has gone through in the last sort of 12 to 18 months. And you've seen, 2 handfuls of funds raise 50% of the capital, and that isn't going to be providing the venture returns that they're promising to LPs. And so if you think about the illiquidity risk that they're putting their capital under, it's not going to be getting the return profile. They're just simply too big. And so to Scott's point of sort of VC 4.0, I think about it very much on a sort of fund size perspective. And so the fund sizes that can produce the venture returns are those smaller funds where quantitatively, qualitatively, it just makes more sense. And for the founders that are in the room, you want people who are running for their 20, their carry, as opposed to walking for their 2. And there's too many funds out there that are simply walking their way to being, quite frankly, rich, and aren't necessarily incentivized about whether their fund, their companies perform well. That
2, by the way, it's the 2% annual management fee that the GPs get. That 2 is $600 million a year for those for that handful of funds that have taken up over 50% of the capital in 2024. $600 million a year for just showing up and giving you founders a hard time and asking you lots of hard questions. I'm sorry, that doesn't work. And so then what happens in PE, by the way, the ROIs are on top of PE now. Mid-cap PE and venture ROIs are basically on top of each other from the last Cambridge data. So now what happens is, what are the LPs? Some of the LPs, the institutional LPs, they start playing this game. They're like, yeah, I'll give you $200 million to your fund. Can I have some of the GP? Can I get some of the fees? And then you're going to start seeing these big guys start charging the portfolio companies for services. It's literally converging PE.
It's terrible. Any VC that starts charging for services, I think, is just a conflict of interest, because then it drives all the wrong behaviors. So I think that's maybe something as an entrepreneur, you should really watch out for this kind of services. That makes sense. It looks like a win-win. But actually, it's a small win for the entrepreneurs, a bigger win for that VC, and a really big lose for all the syndicate.
Yeah, the other thing I'll say about like the phase 2 and 3 of venture capital, which another thing to keep an eye out for, is it went from craftsmanship to assembly line. Like when you look at a lot of the GPs that were minted in those 3,000 venture capitalists that showed up in the last couple decades, their idea of venture capital is this. Like literally, it's assembly line working. It's like, and now I'm a venture capitalist. Like, hey, seed fund, great. I'm an A. Here, B. And that works if everybody keeps adding, right? But when this guy goes to lunch, everything starts stacking up over here, and I'm like, wait, I thought it was a venture capital. What's going on here? And so that's why I think we'll see a return to that first era of like true craftsmen, people that roll up their sleeves, go arm in arm in battle with their founders, because it's tough. It's really tough.
Maybe I want to touch on something that links to this 2% management fee and the wrong behaviors. And clearly this annual 2% management fee is a lot of money when it's a big fund, and it drives very different behaviors and different team sizing and everything else. But for the smaller fund, they actually really need to work for the carry. And we talked about it backstage, but it's nearly like the venture class asset class really should be split into two. And I think you made the point, it's already forked, which is, and I don't know if it's 200 million or 300 million, but I think the asset class of smaller funds really behave differently and are really there for the entrepreneurs and really supporting them much more because they have to make them work, because they have to make them successful so that it becomes fund returners. While for the bigger funds, the behaviors is very different. If I'm thinking about an asset class, you have the private equities and you would have these big funds, and then you have the smaller funds. It may be something in between too, we could argue, but I feel like that fund size could be what defines two very different behaviors and therefore different risk profile and therefore different asset class.
I love the headline coming out of this panel, Ventures Forked. And for those with accents, it's like, what did he just say?
Especially with a French accent.
Yeah, what did he say? Ventures Forked?
I mean, you've only got to look at the returns of the last 10 years. The median fund size at top decile is 38 million. So these small funds, they're not just qualitatively trying to work harder for their carry, like they actually are performing and providing the returns back. And I think maybe to try and, I guess, align your point around the capital infrastructure stack to a bit of the topic of conversation today. Certainly when there is that sort of drawback, that flight to safety, the places that get affected first are those sort of emerging geographies where that capital infrastructure is less prevalent. And so the US will still be fine because if you're a great pre-seed founder, there's going to be 15 to 20 seed funds queuing up at your door for the seed. The same for the A, the same for the B. When we're talking about some of these sort of more emerging geo potentials, with high quality talent, the talent can be anywhere. Anyone can found a great business can be found anywhere. The problem is they don't have that capital infrastructure behind them, which we're maybe arguing shouldn't exist today, but it does help them get to those next stages.
Yeah, thank you so much, James, because you're bringing it back to our topic. And you're mentioning that the US is basically the leader in the funding market. What type of disparities do you see in the different markets that you guys are investing in, and how can we overcome them?
Happy to kick it off. So, I think about this sort of in three different ways. So one is the ability to actually create a company. The second is the sort of adoption speed of that tech. And then the third is the capital to kind of support them on scale. And if you think about where these companies are kind of being founded, it's very much, for me, like a bit of a mindset piece. So in the US, failure is taught to be an experience. It's something encouraged. In Europe, we have as many STEM universities in the top 20 as the US, but those people aren't finding themselves in entrepreneurial seats. And I think that is because there is a bit of a mindset issue in Europe that taking a risk we're very risk averse. Failure is seen as a bit of a mistake. We want to go and look for stability before taking our chances. And I think that needs to change for us to really unlock the talent that we have quite frankly. From an adoption speed perspective, Europe has been slow to some of the tech trends in the past. We were slow to the PC wave, the internet wave. We're looking a little bit slow to the AI wave now. We love our GDPR and the AI Act, but we're not necessarily as quick when it comes to tech trends. I think one of the places that do that very well is China and Asia generally. If you look at China, they are very quick to adopt technology. It's generally publicly driven, but it allows them to get this tech out there to more people. And then finally, I guess just from that sort of capital infrastructure piece, the US obviously is very successful at that. Europe is good until, I would say, a sort of growth stage, and then we definitely struggle. There's definitely a lot of shopping being done by US funds, and they can pick up assets for sometimes actually pretty good value versus their US counterparts, as long as they can, I guess, unlock more markets from them commercially.
I think the GDPR thing could be an awesome import for the U.S. If GDPR really sets in the U.S. like it should, that would be a big unlock for innovation, frankly, back to consumer. Because the data gatekeepers are basically have locked down the precious commodity as it relates to AI. But if GDPR happens in the way it should, that would be pretty awesome. Putting aside geography, because we can obviously talk about U.S. versus EU, I would just focus on stage of capital. A corollary of the explosion of VC funds is it's really easy to get your idea funded, relatively easy. There are a ton of seed funds. Everybody's a seed investor. Everybody's an angel investor now, literally. And so getting an idea off the ground is much easier than it used to be. And frankly, getting growth funding once you have momentum and once you're hot and you've got, trailing metrics, it's actually pretty straightforward, especially outside of deep tech, but even more so now in deep tech, because all of the investors that were doing consumer and frankly SaaS are now running to deep tech, and they're becoming deep tech funds because that's all they can do, because consumer's been really challenged, and software is basically going away thanks to AI. So there is capital. Here's the challenge, I think, is that valley of death. That point where you've de-risked the tech, you've got a couple customers, you've found your product market fit, or at least you think you have, but you don't have the commercial traction, the rinse and repeat, the repeatable revenue that the growth guys are going to need to see. And you've kind of, I don't want to say you've outstayed your welcome or tested the patience of like the Series A and B guys, but it's hard to get like the Series B extension. And that valley of death is really tricky. And we took a look at the data a while back, and within SaaS, there are about 160 firms that had funded at least 3 times in a 5-year period, so repeat funders, SaaS companies in the valley of death. For deep tech, there were this many. Not a single firm had done more than 3 investments in the range of $75 to $100 million raise, $125 million raise. That's scary. So you could come out of the gates and feel great about your product, and you get through the tech risk, and you got your design partner, and you might even get like the little golden cohort put together, and then you're like, oh, this is amazing. Now I'm going to go raise $40-50 million because look at my orders. I've got 150 million orders. Who's not going to fund that? I can tell you who's not going to fund it. Most people, because the growth guys are trying to look at trailing metrics, and most of the momentum for deep tech has been in the Series A and B. More like seed and A, frankly. And that's the challenge, is that valley of death from a capital perspective.
I can even speak to that within the climate tech space. But I think first, in deep tech, the repeat entrepreneurs don't come as often as SaaS. So maybe in SaaS, they come every 3-4 years. In deep tech, it may take every 10 years, 15 years before they restart something. But in climate tech, we have this valley of death, which typically is a first of a kind, which is the first time that you have your product really in with a real customer. And that takes a lot of CapEx. And at that point, you need to rinse and repeat, and it's extremely expensive. And that's where private equity needs to come in, or you need to have a nice exit or a nice M&A. And the problem in climate is that it's a lot to do all at the same time. And when we started, so we started in 2023, fund EX1. EX is for energy transformation, and that's a decarbonization fund. And our thesis was geographic. So we're talking about high potential regions. We thought for climate, it was North America and Europe. But the investment thesis was different from North America and Europe. North America was all the tailwinds to do with regulations, which, by the way, maybe some of you think are headwinds now. But I'll talk to the amazing or quite significant overlap between decarbonization initiatives and energy resilience, which actually helps for our investment thesis. But in Europe, it was all about realizing the energy dependency and the need for reduce that dependency. And we knew that there would be a lot of entrepreneurs in Europe starting new initiatives in climate to avoid that resiliency, that dependency. And as a consequence, now we're looking at these investments we do in climate that are going to really help moving forward. But we have that valley of death where we do need partners that can do that pre-IPO funding.
I think the CVCs can play a great role there.
Actually, I was thinking about this because you talked about 3,000 VCs. Well, about 3,000 corporate VCs active today. And I could see how the number of VCs will decline slowly because management fee allows them to go slow on their death path. But it's quite possible that we may end up with 1,500 VCs, but we may end up with 6,000 CVCs because it's such a good exploration tool for big corporates, and I would say big corporates, at least $1 billion revenue size, to really have this tool set of innovation and explorations that I think there will be more corporations that understand how to do corporate VC well and be able to invest. And I agree with you that corporate VC can be there quite early stage, and then the corporate can then move in that valley of death. So I think there is a hopeful aspect to it.
A question for you, Scott. So we have a fairly active co-investment program. We generally start that around a Series B stage, so some of these sort of growth companies. And I would say the last 4 or 5 months have been heavily dominated by these deep tech or much more technical investments. And the leads that are coming in to kind of do these rounds are not traditional deep tech investors. So I guess maybe just a sort of general question is, do these deep tech companies always need deep tech investors when they're at these sort of later stages? Can they have perhaps more technical GPs with them at the early stages where the tech hasn't been de-risked, but when the technology has been de-risked, and you could maybe argue that is when these bookings are starting to come in, can it be that these VCs that are perhaps better at supporting scale come in and actually add value and avoid that sort of valley?
Yeah, boy, co-invest. So in the 10 years that I've run ACME, we've done over $1 billion of co-invest with our LPs. A lot of that's just direct because we partner closely with the LPs and just have them come in. We really backed off co-invest in the last 3 or 4 years because we lack the conviction to advocate to the LPs and to pound the table. And we blew it on some. The challenge with co-invest and most LPs is they look to the GP and they say, okay, has this been de-risked? And you're like, kind of, yes. But then you might have other funds marking up around. Like we have a situation right now where not a lot has changed since we did the last round, but it's now being marked up by brand name firms on basically like a 3x. And some of our LPs are like, hey, this is hot, can you get us in? And we're like, nothing's changed since we valued it 3x ago. And like, this is dangerous, right?
So do you say that to them, or do you?
Yeah, we do. And it's funny, I just was with them in London yesterday, and I was with 2 of my LPs, and we had this conversation of like, how do we handle this? And they had a really simple response. They're like, we appreciate your concern, show them to us. In answer to your question, 100%. But they have to, the question was, can non-technical GPs do deep tech later stage? 100%. You don't need understanding of deep tech, but you need deep tech patience. And deep tech patience is unique because it might mean we're coming back to the well. It might mean of like, hey, you did this SPV, now we're going to have to do an extension because that contract that we thought was going to come in 6 months from now is going to be 18 months, and we're running out of cash, but that contract's huge. We need more capital. And if you're like, hey, I did my round, that's scary, right? Because we obviously don't have the capital because we're a smaller fund and we're relying on our LPs to support it. So you got to come in eyes wide open.
So Marie, I want to give you a chance to answer to your question. So there are a lot of regions which I think have high potential, and there is a funding gap, and that's typically a VC opportunity, because if you have really high quality entrepreneurs in a region that start to have something special, the valuation will take time before it catch up, and you could make really good investments. We've set up an office in Bangalore for that reason. We think that what's happening today in deep tech in India is unparalleled. They are known for SaaS, but now you have all these amazing engineers who used to leave India to go to the US and other places. Now they stay. Not only they stay, but they work in startups. And the reason is that there have been so many success in India with entrepreneurs going IPO and so on, that now the parents don't say, don't go to a startup, go to a safe company. They say, of course you can. And this creates an opportunity for us to invest in India just at the right time. But I also want to say, I went to Kenya, and I think Africa is going to be really interesting to watch, especially they are very entrepreneurial, and they always think about use case and unit economics. And next month I'm going to Brazil, which I think South America is also one to watch.
So you think Africa is it time?
I think that for mobility, electrifications, maybe climate.
Picks and shovels, the basics, the utilities, yeah.
Yeah, I think, but it's interesting because for us at TDK Ventures, we're looking at what could start in one location for very good reasons. Like in Kenya, they have a lot of things that are making it the perfect storm for electrification of mobility. And then how could one entrepreneur build a startup that becomes successful locally and make it global? And this is where I think we need to watch out. Yes.
And I guess from a CVC perspective, there's two advantages to going after these pieces. Number one is you generally don't have external LPs saying, where's my money, where's my money? You can be as patient as you want.
Oh, you think they don't have?
You can, but the strategy can be a little bit more like, do we want to play this game long term? And if the answer is no, you don't do it. If the answer is yes, you can do it and you can back it and you can be patient and you don't have external voices in your head or external pressures or the fact that you need to go and raise another fund in 2 to 3 years' time and show DPI or show where your exits are going to come from. If you believe that strategically these are really interesting places, you're like, hey, well, we can follow these businesses.
I'd say something provocative, but in VCs, you know you're expected to give DPI. And for corporate VCs, you know you're going to be expected, but you don't know when you're going to be expected.
I'm going to follow up on what you were saying and giving the example of Bangalore and Africa, where they are very entrepreneurial. How do you bridge the gap between these regions where they are very entrepreneurial, but they don't necessarily have the liquidity? And then if we compare, for instance, with Saudi Arabia, where they have a lot of liquidity, but they are not very entrepreneurial because of the culture. How do you bridge the gap of these disparities?
And that's what I was saying is these funding gaps is the opportunity. It's like when there's an opportunity, when there's a pain somewhere, it's an opportunity for a startup to go and solve that pain. And when I see high quality entrepreneurs with high quality tech working on a really high quality pain point, not a vitamin but a painkiller, and I really want to go and invest in that space. And I think India right now is where corporate VCs can do so well. They already have a really good VC ecosystem now, which 15 years ago, there was no such thing as deep tech VC in India. Now it's actually starting to mature, and we have really high quality VCs in India, but very few corporate VCs. And at TDK Ventures, we saw it as a unique opportunity for us to come, and we have created actually an innovation hub in Bangalore, where every CVCs can come and be welcomed into our space so that we can collaborate together. And the opportunity for us is to have these companies that are going to be what we call local king of the hill. They are going to be the market leader locally. But now the corporate VCs with the corporations behind, which is what I call our superpowers, we can make them global. And I think that's where you were leading me towards.
Yeah, I mean, if you take those two regions as kind of two different sides of the fence, I mean, Saudi Arabia needs the talent. You can't have anything without the talent, but could they bring the talent to the country? Most definitely, especially when you look at places, you know, for example, in Europe, which haven't necessarily been incentivizing their best talent to be building things in their regions. It's only going to be them.
Sorry, I'm interrupting you. I can't say it, sorry. But that's actually one of the missions of Hello Tomorrow. We are working a bit in Saudi Arabia and doing some consulting activities there. And one of them is building soft landing programs to bring in the talents there. So I just wanted to mention that on the way. Yeah.
Little plug there. Awesome. And but if you think about the India side, for an investor, say myself, I focus a lot on the US, Europe. We've done a bit in the sort of MENA region as well. If I'm looking at India from a sort of outlet lens, I'd be thinking, okay, interesting people. They're building companies in India. They're not necessarily immigrating to the US to do it anymore. But whereas I myself can't, it's a bit of a chicken and egg, but I myself can't help these companies go from 0 to 100. It needs hundreds of me, thousands of me. So I think that's the challenge, is like, how do you get to conviction yourself, and how do you get to conviction that lots of other people are going to get to conviction to you as well to support that specific region?
I like to think that VC is about being right 4 years early. If it's more than 4 years, you're never going to make it. But if it's 4 years early, 2 years later, some people start to also believe in what you invested. And then 2 years extra, then everyone believes it. And by the time everyone believes in what you invested, the price is in, the valuation, you won't get your fund return. And so I always like to think, wait, is it Africa? Actually, that was a good question from you, which is Africa 6 years too early, or 2 years too early, or 4 years too early? This I don't know. But what I know is that Bangalore is probably now 3 years, 2 years too early for deep tech. And that's why I really am bullish.
People have been saying that for a while. But that'd be awesome if it flips. Here's a crazy idea. The EU. We're bullish. We've got a partner, Christian, here, third row up, that good-looking guy, skeptical of everything I'm saying. He's based in Copenhagen. We're probably going to add someone else here in the region. Why is that? Well, first of all, there's amazing. Think of the innovation landscape as like a restaurant, right? You need great chefs and you need wealthy mouths, wealthy diners. You can go to Israel and you can find great innovation, but it's a tiny, tiny market. You can go to the kingdom and you can find a lot of money, but there's not a lot of innovation. There's a lot of wealthy mouths to feed, but there's not a lot of it. So Europe's got it both. Now, Europe isn't perfect, and you got to figure out how you're going to go from, region to region, culture to culture, and you have to deal with the guys over on the island. But honestly, that seems a lot easier to figure out now, given recent kind of geopolitical evolution, I apologize, from the U.S. And I don't think you're going to see U.S. companies rushing over here like they used to. Like that game is going to be put on pause. So I invested in Uber Series B, and from day one with Travis, we're like, okay, let's get to Asia, let's get to Europe. My companies today aren't talking about that. Like, they're not saying, let's get to Europe. There's plenty of work to do here in the US, and now with tariffs and all the uncertainty, honestly, it could create a chill. And we used to do a lot of investing in China. We don't touch that anymore because it used to be fertile ground for us, and now we're not even really invited in. They don't want US money. And I'm not saying Europe doesn't want U.S. money, but that I think there's our colleague calls it the clay curtain instead of the iron curtain. But there's a wall emerging between the U.S. and Europe that didn't exist a few weeks ago. If that sticks, I think Europe becomes more interesting because you're going to need European solutions, especially in aerospace and defense. I mean, look at the U.S. GDP. U.S. spends 3% of the GDP on defense. I do a lot of aerospace and defense investing. Guess how much Europe basically spends on defense historically? It's about 1.2%. Guess what they've claimed they're going to take it to? 3.5%. That's huge. And you can find a lot in aerospace and defense that's not just stuff that blows up. It's sensors, it's automation, it's AI, it's a bunch of things that support the industrial sector. We call it dual use, which is a great word to use with your LPs. It makes them happier when you say it's a dual use technology. And so this is going to be big in Europe. It will be. We put money in a company, a Paris-based company called Ramond, and it's a small company that's going to be very big soon. And we think it could be the next Anduril. And we're going to see these independent European companies emerge. I'm much more bullish on putting money in Europe than I am Africa right now, or India for that matter. Because I was talking about Africa and India at Goldman 20 years ago, as about 4 years out, and I'm way more bullish on putting money here.
It'll be right one day. I think maybe just to sort of add on the EU train, I wrote a piece on it this week saying will Europe sort of wake up from being a sleeping giant? And what I kind of mean by that is that we have the talent right here. We just aren't finding them. They just aren't finding themselves in the right shoes. And if you think about things that aren't necessarily going to change about Europe, we have a great time zone. We can speak to everyone all over the world. Not everyone can say that. Culturally, we have some interesting cultures. We have a good form of capitalism, I think, that doesn't end up in the extremes you're seeing in the US, but still pretty competitive. And so, and as well as that, just from a sort of entry price point of view, I'll take seed as a bit of a proxy because that's what we look at most with our managers. It's 150% cheaper. And so, if you can get into these companies at that price, there could be some interesting alpha to be made. Now, I guess what one could argue is that sort of Europe's stagnation already priced in? The fact that it doesn't have a good growth capital infrastructure there to support these companies at later stages, the fact that people aren't making their way into those seats historically, is that sort of pricing in what it's worth? That's the kind of bet for allocators and for GPs, is that, okay, there could be some interesting alpha to be made, or it could be priced in.
I think one of the things that we're talking about is really where talent and capital match and where it doesn't, and that's a funding gap that could be a potential. I want to give a shout out for Hello Tomorrow because you're helping that fluidity improvement between talent and capital. But we are talking about Europe. I think you've all seen Northvolt news. This is actually unlocking talent, really amazing talent from Northvolt to go and found many startups like we've seen in US with Tesla. So, or actually even before that with Nokia. Many amazing startups are going to be born from the news we had this week. So I think we should, I'm very optimistic about Europe. We set up our office in London. It was for climate, but if I was to choose my next, probably Germany for industrial mobility and so on. There is a funding gap in Europe, which I think corporate VCs, but also bigger VCs can do a lot.
I agree. I think Central Europe, broadly EU, is more interesting than the UK. I'm not in a hurry to put someone in the UK. I mean, it's lovely, but I think the action's here for sure. And then I will do a shout out to the region, to the Middle East, and you can call me on the ears here. I'd like to believe normalization is coming. And if we see a normalization between basically, I'll say it, the ends of the spectrum, Israel and Saudi Arabia, that would be a massive unlock. It's not going to happen tomorrow, and there's a lot we need to figure out for sure, but it would be a massive unlock in that region because all of a sudden you're now marrying people on a similar time zone, amazing talent, innovation talent with hungry mouths, capital. And eventually those companies will find their way to where just the capital is, and they'll have offspring that will be innovative. And then you'll see the ecosystem go. But you're going to have to see normalization of relations and flights and, put the guns down. But if that happens, that's going to be extremely interesting.
Matching talent with capital.
Yeah. Maybe one last question, a bit tricky.
Can you fix the normalization thing? Just get that done and then add that to your agenda of your group.
Done. One last question, very quickly. how do you see the current geopolitics impacting?
Pass.
Pass.
I got the wrong accent for that one.
So I'll speak to that because I think, well, first there are two things. I hinted to this change with the new administrations about what used to be a big push for decarbonization, and now it's more about energy resilience. What's interesting is if I look at my portfolio, what I've invested in, like for example, I invested in Peak Energy, which is doing sodium-ion batteries for grid storage. Amazing for decarbonization. Absolutely necessary for grid resilience and the big boom of AI hyperscalers and data centers we see. If I think about Novalis, I invested in Sydney doing direct lithium extraction. That's an amazing thing to avoid the lithium that you need for your batteries. You just recycle locally, so you don't need to have it shipped around from countries which you may not be in friendly terms anymore. So I think there is a lot of things which are interesting. The second one about geopolitics, and we can take a view. We can take a view that we will be back to globalization and everything is fluid. And we can make bets according to that. As VCs, our job is to make bets, assuming different directions. Or we can make a bet which is it's only going to get worse. What does that mean in terms of opportunities for entrepreneurs to do extremely well? And we have this concept at TDK Ventures, which we call challenger technologies. And if you think about climate tech, wind, solar, lithium-ion batteries, they have won the game for climate. They are massively deployed with really good unit economics. But there are many others which haven't got to that right unit economics. And geopolitics might be what helps this technology to really get out there. And we talk about SMR for nuclear fission. I personally invested with TDK Ventures in nuclear fusion with Type 1 energy. It's a stellarator approach. That's the kind of technology that wouldn't have the same chance to get to the positive unit economics if it was not for the geopolitics today. And if you think about nuclear fusion, this is like the holy grail we're all looking for. Continuous green energy, you only need one thing, water. Which means that every country could have their green energy locally sourced, which, by the way, if generative AI continues as it is, and it will, we need that.
So I'll just say, look, I'm from the Midwest. I grew up in Indiana. I'm an optimist, and that's why I do this job. Most venture capitalists are optimists. I like to believe we're on a path to globalization. I believe we can all get along. I'm talking about normalization in the region. Like, I hope we're going to get there. This is an experiment for sure. This is weird. Again, didn't see it coming. I kind of did. The one thing we as VCs always say is with disruption comes opportunity. And that is exactly what you're saying. There's tremendous disruption happening right now. It's a wake-up call to the rest of the world that I think everybody got a little lazy. Everything got a little fat and bloated, and this is breaking things in a radical way. And that'll create some interesting things, and hopefully the positives will outweigh the negatives. There's definitely going to be some pain along the way, as we're seeing. But, you know, I'm optimistic.
I can't remember the Japanese word, but there is an art in Japan where you break a plate and then you put it back with gold. And I think all of this breakage we see today, a lot of good will come out of it. And these challenger technologies I just mentioned are part of the solution for a better world. And sometimes this breakage we see, and the new administration, the tariff, and all of the things we see, there will be a lot of good that comes out of it. Because I do believe entrepreneurs will bring the best out of any opportunities, even when it looks dim.
VC 4.0.
Yeah, perfect conclusion. Thank you so much, Nicolas, James, and Scott. The speakers will be outside if you have any questions. Thank you so much for attending this panel, and I hope you will enjoy the summit.
Thank you,
Thank
Mary.
you.
Thank you, guys.